Adam Kobeissi with us right now, the Kobeissi editor-in-chief. Adam, you heard a little bit of this conversation we're having. The real problems and the concerns about government debt run amok. And, while it might be very popular to talk about tax breaks and the like for certain groups and constituencies, everyone will want their share, right?
Yeah, deficit spending is right now actually at World War II levels. So we're actually seeing crisis level deficit spending right now in a time when the Fed is calling for a soft landing, and the economic data is actually coming in pretty strong. So I think, and that's also inflationary. So I think we need to definitely find a better long-term solution here, or it's definitely a crisis brewing over the long term.
I don't know what exactly lasts in the mortgage arena, but mortgage rates have been coming down. We're under 6.5% for a 30-year fix. Wasn't long ago we were comfortably or uncomfortably over 7%. It's ignited a lot of mortgage refinancing interest, a lot of mortgage interest. Still, the cost of homes is prohibitive no matter where you go. How do you see this sorting out?
So it's a really interesting situation in the housing market right now, because we're coming off a period where interest rates were historically low. There's just roughly 60% of borrowers have a mortgage rate right now below 4%. And then meanwhile, now rates are starting to inch lower. But it's going to be hard to find a point with interest rates where there's that financial disincentive for existing homeowners to sell is alleviated, right? Because you're sitting at 3, even if rates fall to 6 or 5, most people are locked in here. And now you're seeing, for the first time since 2005, the new and existing home median sales price is the same. So typically existing homes are cheaper than new homes. Something's wrong when they're selling for the same value, and soon existing homes will be selling for more. I don't see that changing anytime soon, even as rates start to inch lower. It's on a net basis. If people start moving and selling their homes, supply isn't changing on a net basis. What you really need to see is investor-held homes being sold, and with those many investors having locked in rates near 3-4%, I don't think that's going to happen anytime soon. So in my view, I don't think housing affordability improves over the medium to short term.
But the fact that people are showing an interest in refinancing, certainly looking at homes, whether they'll actually get them in this environment is anyone's guess. And they're clearly shopping, and Walmart indicating that, the latest retail sales figures showing that, all the retailers up rather nicely in the stock market today. The consumer might not be as tapped out as earlier thought. Real quick thought on that.
Yeah, I think, it's definitely slowing. I don't think the consumer is necessarily collapsing, but also, in the latest Fed data, total household debt just hit a record $17.8 billion, credit card debt's over $1.1 trillion. So you have, and rates are still very high, credit card debt rates at 25%. So I think a lot of this near-term strength in the consumer has actually been fueled by leverage and borrowing, rather than, necessarily wage growth and an overall strong consumer. So I think right now we're kind of just brushing the dirt under the rug, but over the medium to long term, it's definitely not a sustainable path that we're on right now.
All right, Adam, thank you very much. We're also following Ernesto. There's now Category 1 hurricane that is churning not too far off of Bermuda right now.